Welcome to 3 and 3. Today we're going to be talking about fiscal policy, monetary policy, and broadening of the markets. So monetary policy. So one of the main tools the government uses to influence the economy is monetary policy, which involves the central bank managing the money supply, interest rates, and the overall economic stability. Currently, the Fed fund target is 4.25 to 4.5%, and that's following 1 percentage point of cuts in 2024. By the end of 2025, the Fed is expecting to lower rates by 0.25 to 0.5%. This small reduction in rates contrasts to what many actual economists had forecasted for the Fed to cut 4 to 5 times by the end of 2025. So what you're looking at here is the Fed's balance sheet. And you can see the Fed has been trimming their balance sheet since about 2022. And that consists of mostly mortgage-backed securities and also treasury bonds. About $60 billion a month is being dumped off the Fed's balance sheet into the economy, and that's increasing the supply, which potentially could keep rates higher and put a little bit of drag on the monetary policy and the economy. So fiscal policy, the other main focus that the government has and influence on the economy is fiscal policy. And that refers to the government's use of taxation and spending to influence the economy. It's controlled by the president and Congress. The key fiscal policies currently under consideration are the extension of Trump's 2017 tax cuts, additional tax reductions, the increased defense and border security funding, the Stargate project, a $500 billion public-private potentially aimed at constructing AI infrastructure across the nation, debt ceiling negotiations, and fiscal responsibility initiatives, and government efficiency and workforce reduction led by DOGE, and lastly, potential cuts to social safety net programs, including Medicaid and food assistance. So what you're looking at here is the outlays, which is the red of the actual Federal Reserve. And the blue is the revenue, and the deficit, as you can see at the bottom, is growing. So if we can continue to reduce some of that overspending from the government and bring in the actual deficit, that will continue to maintain our dominance in the world as a U.S. reserve currency. The broadening of the markets. So given the current market dynamics, we anticipate a broadening of the stock market returns beyond now that Mag 7 stocks, which makes up about 40% of the actual S&P 500. While we continue to favor large cap stocks, small and mid cap companies could see a greater benefit, especially if interest rates decline more than expected. Additionally, there's potential for international stocks to outperform, and that hasn't happened since the mid 2000s. The perception is that U.S. stocks are slightly overvalued, and there's growing sentiment that Europe and China's economies may be recovering, and maybe we see some fiscal stimulus. So as we look at valuations and we look at 1-to-1, the U.S. stock market is 1.04, meaning it is slightly overvalued, especially when you look at large cap growth, mid cap growth, and small cap growth. But if you look at the value side, you can see that the value is below 1, which could show some potential growth or some potential returns in 2025. And we're starting to see a little bit of that rotation. And that's that broadening I'm talking about. The stock market may actually start to move into other areas, not just that Mag 7. Thank you for joining us for 3-3.